January 13th, 2026. That date will be remembered. Because on that day, silver didn't just rally, it broke history. Silver surged past $88 an ounce, printing 88.37, and in doing so became the strongest performing major commodity on the planet. Not for the year, not for the quarter, but across the entire cycle. Over 210% gains in just 13 months. And that's not speculation. That's math. But here's the most important part. This was not a random spike. This was not meme trading. And this was not a bubble popping early. What happened in silver is the result of pressure that has been building for years, finally releasing all at once. To understand why silver exploded, you have to understand why it had nowhere left to go but up. For most of the past decade, silver was ignored, underallocated, dismissed as too volatile, too small, too industrial, too inconvenient. While capital chased tech stocks, crypto cycles, and bond illusions, silver was quietly being consumed, not traded, consumed. And that distinction matters. Because you can't print silver, you can't pivot production overnight. You can't replace it in critical systems without redesigning entire industries. Silver isn't optional, it's embedded. Now fast forward to 2026. Inflation hasn't vanished. It's been managed, masked, redefined, but not defeated. The US dollar, while still dominant, is weaker in purchasing power and credibility. The Federal Reserve is boxed in, unable to tighten aggressively without breaking markets, unable to ease without fueling inflation. In geopolitics, they are anything but calm. This is the perfect environment for safe haven demand. But silver doesn't get just one tailwind, it gets two. Because silver is not only a monetary metal, it's an industrial lifeline. Solar energy alone consumes hundreds of millions of ounces per year. Electric vehicles rely on silver for conductivity, power management, and battery efficiency. Defense systems, from radar to missiles to secure communications, are silver intensive. And AI infrastructure, data centers, high-performance chips, power routing systems. Silver is everywhere, invisible, and irreplaceable. That's why demand didn't break when prices rose. It intensified. Because industrial buyers don't care about spot price. They care about supply certainty. When availability comes into question, price becomes secondary. And this is where the real story begins. For the 6th consecutive year, global silver demand has exceeded supply. 6 years. In any commodity market, 1 year of deficit is notable. 2 years is concerning. 6 years is structural failure. Mining output hasn't meaningfully grown. Ore grades are declining. Costs are rising, permitting timelines stretch into decades. And silver is rarely mined alone. It's a byproduct of other metals, meaning supply cannot quickly respond to price. So when demand surged, supply didn't, and the gap widened. Quietly at first, then violently. Silver's market is small. That's not a weakness. That's a multiplier. When capital flows into gold, it absorbs it. When capital flows into silver, it moves it. Fast, hard, relentlessly. This is why silver outperforms gold in bull cycles. Gold preserves wealth. Silver amplifies it. And once momentum starts, it feeds on itself. Rising prices validate scarcity. Scarcity validates demand. Demand drains inventory. Inventory loss fuels panic. And panic obliterates resistance. By the time silver crossed $80, the move was already irreversible. 80 wasn't resistance, it was confirmation. And yet, despite the historic surge, despite the 6-year deficit, despite industrial demand screaming, some analyst forecasts still sit at $42, $43, numbers that belong to another era. Those targets weren't wrong, they were obsolete, based on a world where supply chains worked, where inflation was transitory, where geopolitics were stable, and where silver was treated as surplus. That world no longer exists. The more realistic base case now places silver between $85 and $95 as an average, not a peak, an average, with bullish projections pushing past $100 as supply deficits deepen, and extreme scenarios where de-dollarization accelerates and physical shortages intensify point far higher. But here's the key insight. This rally wasn't driven by hype. It was driven by necessity. Silver didn't rise because people wanted it. It rose because systems require it. And when systems compete for scarce inputs, they don't negotiate. They outbid. That's why this move feels different. Because it is. This is not the end of the silver story. This is the end of denial. And in part 2, we're going to break down what happens after silver breaks records. Why volatility increases instead of calming. Why pullbacks don't restore balance. And why this market is no longer governed by charts, but by availability. Because when a metal becomes strategic, price stops being a ceiling and starts being a signal. Now here's where most people get it wrong. They see a record price, they see a fast move, and they assume the hard part is over, that the rally has played out, that what comes next must be exhaustion. But In structural bull markets, the most violent moves don't happen at the end. They happen after disbelief breaks. Because once a market crosses a psychological threshold, behavior changes. Risk models change, procurement strategies change, and capital allocation rules change. At $88, silver didn't peak. It reclassified. For years, silver lived in the optional bucket. Nice to have, tactically tradable, easily ignored. Above $80, it moves into the strategic category, and strategic assets don't trade the same way. They are acquired, secured, hoarded. This is where volatility increases, not because the market is unstable, but because supply is inflexible. When demand surges for software, price stabilizes as production scales. When demand surges for silver, price accelerates because production can't. This is why pullbacks in silver no longer reset the market. They are absorbed. Every dip is met with buyers who were previously waiting, industrial buyers who can't afford delays, investors who missed the first leg, funds reallocating after confirmation. The structure has flipped. Weak hands are gone. Strong hands are still building. And this is why forecasts that stop at $90 underestimate the situation, because they assume normal elasticity. Silver is no longer elastic. The supply deficit is not cyclical. It's embedded. Solar infrastructure alone requires sustained silver usage for decades. EV adoption isn't reversing. Defense spending is accelerating. Grid upgrades are mandatory. AI power demand is exploding. There is no scenario where silver demand meaningfully declines without a global industrial collapse. And even then, monetary demand would replace it. This is silver's paradox. When growth is strong, industrial demand pulls it higher. When growth weakens, monetary demand takes over. Few assets have that dual support. Silver does. That's why analysts who once dismissed silver are revising their tone. Not because they suddenly became bullish, but because the data forced their hand. 6 years of deficits. Constrained mining, inventory drawdowns. And now, price confirmation. This is the point where narratives shift, media coverage expands, public awareness grows, and participation broadens, not all at once, but steadily, then suddenly. And that's when volatility becomes emotional, not technical. You'll see sharp rallies, sudden drops, fake breakdowns, headline-driven whipsaws. But underneath it all, the trend remains intact, because the driver isn't sentiment, it's necessity. This is why silver outperforms late in cycles, because it's the last asset people reach for, and the hardest one to replace. So what does this mean going forward? It means silver is no longer asking permission. It's enforcing reality. It means the conversation shifts from, is silver a good investment? To, how much exposure is enough? It means risk isn't owning silver. Risk is being underexposed to a metal the modern world cannot function without. And it means price targets will continue to rise. Not because of speculation, but because each new high reveals how tight the market truly is. Silver didn't surge because the market became irrational. It surged because it became honest. Honest about inflation, honest about supply constraints, honest about industrial dependency, honest about monetary erosion. This is not the end of the move. It's the end of pretending silver was optional. And as 2026 unfolds, silver will continue to remind markets of one simple truth. You can manipulate narratives. You can delay recognition. You can suppress signals. But eventually, reality prices itself. And when it does, it doesn't ask permission.